Hey everyone, the Swing Trading Club here. We are back from the 4th of July and we have a lot to get through. We're going to talk about overall market sentiment, where I think things are headed. We also have a few economic reports to get through, and also the latest from the Fed and what we might expect in the coming months in terms of inflation, rates, and all of the above. So let's hop into it. So first thing I want to look at is the Nasdaq's reaction and what traders were looking at when this job report actually came out. So as you can see, this is actually on the minute chart, so we're really zooming in here. But it's important to look at the volatility. Obviously, as we increase our range, it's going to smooth out. But it's curious to see, pre-report, post-report, and then kind of the aftermath to close the day on Friday. You do see this large volatility, and we're going to get into why that's actually happening, but let's kind of have that as a footnote and a foundation for our conversation here. And we're going to flip over to just the headline just from CNBC that I'm sure some of you already read, but payroll increased 372,000, which is more than expected. So why do we see this market volatility, right? We have a huge win in payroll. Why are we seeing this drop? Well, the drop is due to the fact that the Fed, again, like we've talked in previous weeks, they're really fighting multiple battles, right? They're fighting the inflation fight and then also the overall, quote unquote, the economy, right? So when you have job numbers that are, beating expectations, that signals to the market, hey, we have a strong labor market, so we are in a position to continue to hike rates to fight inflation. So that's kind of the underlying idea behind why the markets had such a volatile week. And let's just quickly jump into actually the report itself. This is always from Bureau of Labor Statistics, so that's just bls.gov. I'll put that in the show notes, but I do like to kind of go through this and just really note where these percentages are coming from and what it looks like week to week. They break it out by leisure and hospitality, healthcare, transportation and warehousing, manufacturing. The manufacturing, this is actually a big win. Typically in any kind of downturn, we're starting to produce less just because there's less demand. And so to see manufacturing increase by 29,000, that's actually very positive. I usually am pretty pessimistic lately just due to the overall tailwinds that the headwinds that I've been seeing. But something like a 29K bump up in manufacturing, that's pretty positive. Now, I definitely don't think we're anywhere near out of the rough waters per se, but it is good to see and take the wins as we can get them. So I'll let you guys go through this at your own leisure, but this is the general report. Again, beat expectations, up 372,000, and I do quickly want to check in on our Fred data and just kind of give you a visual representation of where we are. This is just overall job openings, so different from that 372,000 number. But we did see a little bit of a decrease from March to May. So just kind of keep that in your mind and put that into your overall thesis. Now, another item is just the overall where we are in terms of what's it look like from a super high level view, right? This is, again, an article by Jeff Cox over at CNBC, and it's essentially just giving us a ratio of the number of available jobs per workers. And right now it's almost 2 to 1. So for every one worker, there are 2 available jobs, which is a pretty interesting statistic and something that certainly hasn't been the trend over the last 20 years, right? It's been much tighter than that. So again, from the Fed's perspective, and Jerome Powell's, he's saying, hey, we have a super strong labor market. We're going to continue to hike rates. So that's kind of why you had that volatility in the market. Now, final things on job reports before we move on. This is actually a pretty cool little graph, again, from the Bureau of Labor Statistics. And one thing that I wanted to note out here, you can kind of, change the graph as you see fit, but quits, which is just people quitting their job, has really been on an uptick. Now you are starting to see that flatten out, from April to May, a little bit of a decline, but that's really a trend that's, kind of curious. So total separation is also good to look at. But yeah, I'll let you guys, again, sort of play around with this at your own leisure, but it is good to have this as a backdrop and another data point. Now, last week we talked a lot about the mortgage industry, so I'm not going to get too far in the weeds here in terms of housing and all that fun stuff. But I did think it's super important to note about FGMC shutting down, and this is really coming through the entire industry. You're seeing ripples just based on, rising rates, and you're going to see a lot more of this continue to happen. Same thing with Sprout. They're a large originator of non-QM. Non-QM is just kind of like subprime, and when I was at Goldman, we actually used to trade a lot of these and do business with both Sprout and FGMC. So, it kind of hits close to home. But it's important to know that what is happening here, and you see the layoff of 300 workers, and they won't be they'll be out of a job now. So this is going to certainly impact as we start seeing housing as kind of like the last frontier to kind of go. So just pay attention to that. Let's hop into the existing home sales just real quick. I don't want to spend too much time on this, but it's important to highlight, and it's kind of a cool chart that I found here. This is existing home sales versus the 30-year fixed mortgage rate. So again, like we were talking about, with all these layoffs happening, the reason they're happening is because we have such a huge increase in the 30-year fixed rate, right? Back in COVID, as we did quantitative easing and the Fed really dropped rates essentially to zero, people were able to refinance for extremely low rates, get fixed at 2.85, 3.25, etc. Super low rates, and so you had these guys in the mortgage industry making a ton of money hand over fist just due to the rate environment. Well, now that's starting to turn around, so you see layoffs, and you're starting to see a dip in home sales. Now we had that big report that came out, I think in April, where we really saw a decline there, and you can see that on the chart here. But as you can see, just from a high level view, as rates go down, home sales increase, right? And so just kind of put this into historical context for us and just kind of think through what it might look like, especially if you're a homeowner, and where the next couple years, what that looks like for you and how you can plan accordingly. Flipping over to inflation, I want to kind of reignite the conversation regarding the jobs report, right? So when we had the positive job numbers, again, like we've talked about in multiple weeks now, the Fed is really fighting sort of two battles here, right? They have the inflation fight, and they have the quote unquote the economy or the market or whatever you want to call it, right? So we've seen a lot of officials, Fed officials that is, come out and say that there's probably going to have another, I'd say 75 bip hike. That's kind of what the market's already pricing in for July. We're going to get those CPI numbers actually this coming week, so be mindful of that. I know this headline, Fed Governor Christopher Waller, I think he's out of Cleveland, but I could be wrong about that, maybe Atlanta. But he says, I'm definitely in support of doing another 75 basis point hike in July, probably 50 in September, right? So these hikes are going to keep increasing, and we're going to see what happens as the market and the jobs continues to stay strong. And I'd anticipate there's going to eventually start to be some kind of decline there. Now, in terms of what people are actually paying most attention to, inflation is top of mind for everybody who did this survey, right? This is a Monmouth University polling institute. They do a lot of polls. Again, it's not the consensus of everybody in America. It's just, taking a look at whoever answered their polls, so there's always going to be bias here. But take a look at inflation, 33%, 14%, and 5% in July of 2021. So about the same time last year, only 5% of folks were worried about inflation. Prior to that, it's been very minuscule, and you can just kind of see what people are really paying attention to. Back in August of 2020, you obviously had coronavirus. March 2020, same thing. And then it's curious to just kind of go through here and look at what people are most concerned about. So inflation, obviously hot topic in everybody's mind, and it's important in my mind to at least see kind of where the overall sentiment is. So as we continue along this bear market road and we try to position ourselves going forward and trying to understand, what positions do you take right now, especially for long, right? Swing trading is a little bit different, which is what we more focus on. But in terms of trading long and trying to position yourself over the next 5-10 years, presumably post-recession, it is interesting. And I saw this article from Ben Carlson. It's interesting to think through what kind of stocks are actually value versus cheap and what it looks like. So this Ben, who wrote this article, equated a lot of the 2001 kind of tech bubble to just looking at all-time highs, and I think it's a very interesting point that we're going to grab from a few of these stocks and then also look at a few that are currently kind of in this point, right? So what he's saying is essentially that AT&T peaked in 2000, 2001, right? And then say you were to get back in 2004, 2005, it's never came back up to this 44.67 that he marked as the high, right? Now, you can make great returns, going from 13, 14 to 25, 26, right? That's kind of what we do as swing traders. But just know when you're positioning yourself long that these stocks always don't have to run back up, right? Same thing with General Electric, right? If you thought you were buying it super cheap here, hey, maybe you are, and you run up to 275 range, 250 range, but it never got back up to this General Electric, this high back in 2000, 2001. So even same thing here, right? Cisco, everyone's heard of Cisco. Now maybe this continues to trend up, but again, guys, you have to be mindful of when we're in these huge bubbles, these elevated prices, a lot of companies don't end up going back to their previous high. Even something like Bank of America, right? It never got back to its 2008 high. That was kind of the mortgage crisis was the height for a lot of these banks. They were making money hand over fist and never got back to, at least in the case of Bank of America, never got back to that price of $54.90. So that's just something I want to think about as you guys are potentially going long on a lot of these quote-unquote cheap plays. That cheap does not always equal value. So just keep that in mind. And I wanted to flip over to something like Workday, right, which is a pandemic favorite. You saw, a lot of these stocks really running. And yes, we've had a pretty good, last 3 years from it, really, or 2 years, I should say, from 2020 to the height of the market in November of 2021. But just because it's now cheaper doesn't mean it has to go back up to this height, right? So you had, 155% increase, and now we are down about 50%, give or take. So just keep that in mind, guys, that just because something is cheaper than it was at its all-time high doesn't mean it has to get back to its all-time high. We experienced a huge huge inflow of liquidity into the market. So just be mindful of what you're seeing in a lot of these plays and where it can really go to, right? So same thing with Tesla. You had a 2020 dip. It was huge increases, right? 1,300%. That's unheard of in a 1 year time. And so in my mind, we're only down 40%. We could erase all that. That's all excess liquidity in the market, and that's something that the Fed is fighting currently, right? They're taking trillions of dollars out of the economy right now through a process called quantitative tightening, right? From 2020 to 2021, we're engaged in this process due to COVID called quantitative easing. Now it's the opposite, so all this liquidity is going to start drying up. Finally, another kind of pandemic high flyer, if you will, right? From the 2020 trough to peak, we're seeing a 178% increase, and currently we're only down about 30%. So I think there's still a long way to go in a lot of these kind of high-flying tech companies. In my mind, we have a long way down, and it's going to be fraught with peril, really. More or less, there's going to be a lot of little dead cat bounces that try to reel investors in, and it's not something that I would necessarily be comfortable with trying to play at the bottom. So just kind of some overall market conditions for you guys. This is an interesting chart that I found the other day, and I was kind of thinking through how to put this in and incorporate this in our market update. But what this looks like and what this is cash allocation, and this is a Bank of America, just their global kind of investment strategy, right? A lot of these big banks will release, just market updates and stuff like that they're seeing. So what this is saying is their private client cash holdings as a percent of assets under management. So I'm guessing these are high net worth individuals. If you're a private client, I don't 100% know. We'd have to look into the footnotes of this report, but regardless, I think it's interesting to see that during peak February 2009, so that's right after the GFC, the Great Financial Crisis, you saw huge amounts of cash holdings. Now, what this means is investors are essentially experiencing a huge amount of fear, uncertainty, and doubt, so they're moving their positions to cash because they're saying, hey, we don't know what equities are going to look like in the future, we don't know what the bond market's going to be doing, et cetera, et cetera. And I think it's interesting to see where we are currently and how low of a cash holding we are seeing. So whether that means that investors aren't going into equities, whether that means they are positioning themselves elsewhere, but you would expect in this type of an environment that a lot of these folks are starting to gravitate more towards cash. Now, the dollar's been super strong lately, so it is an interesting footnote because remember we saw that consumer sentiment just get absolutely crushed, right? The lowest in I think it was 30, 40 years. That print came out last month, and sentiment is one thing, but how people actually position themselves is another. So we could still have a long way to go before we really start seeing true market capitulation. There's a few other ones that I kind of want to know about, and this is equity allocation. So the other one was cash. This is equity, and you see how back in 2009, right, directly after the financial crisis, you saw equity holdings at an all-time low, right? Everything was blowing out, huge losses, and investors were kind of positioning themselves outside of equities. Now we are still very much equity, at least from this survey, or not survey, but at least from the research by Bank of America. Again, I'm not sure exactly what this is going to look like, going forward, but it's kind of a good footnote to think through. And finally, just stock inflows. It's been flat, so there hasn't been this huge rush into a bunch of stocks, which is you're kind of starting to see this like flattening, right? So again, I didn't know how to really put this in there, but I thought it was a good data point regardless to kind of see, hey, where are people actually starting to invest, and does consumer sentiment match to the private accounts of Bank of America, right? Bank of America is only a small cohort of the market. It shouldn't be taken as gospel, but just like any survey, it does have statistical relevance, and it's important to kind of think through as investors. All right, final section for today before we hop into our weekly picks is I more so just want to focus on what the oil market might be doing in the next couple months. I know there's been a decrease and a pretty strong downturn, but I just for the life of me can't figure out why people are so optimistic that oil is going to keep dropping. I just from the market standpoint and looking at the headlines, it just doesn't make sense that there is going to be any sort of alleviation over the next couple months, especially as winter approaches. You've seen a lot of European countries that are prominently depending on Russian oil, and you're starting to see this kind of strange dynamic. I shouldn't say strange dynamic, but as the headline reads, Russian oil could be hit with a price cap. So what that means is that, it's pretty simple, that the oil is going to be capped at, $40, $50, $60 per barrel in an attempt to kind of create some sort of, less of an impact for someone like the European Union. Now, that, in my mind, and in JP Morgan's mind, as we flip over to this one, might send oil surging, because the problem is you don't have a global consensus here. You have countries like India, China, parts of the Middle East, and Africa as well, of countries that are willing to buy discounted Russian oil, even though you have extreme sanctions in America, in the EU, and other various countries throughout the world. Not everybody's involved, right? So they're not totally, sanctioned out of the market. And I think it's going to be a rough winter ahead, and I think we'll start seeing a rebound in oil. That's a lot of my picks this week from a watch list perspective are exactly that, more so in the oil sector. And again, you can't necessarily say that just because the JP Morgan analyst is warning about a $380 barrel, print, that it's going to happen. It certainly is up in the air, and we shouldn't take any of this for gospel, but it is important to kind of try to, as you think through your overall market thesis, to understand this as a data point. And this report specifically is talking through the supply and demand dynamics. So say you have 100 barrels or 100 million barrels a day for global demand, right? If Russia, what this article is arguing, and if you look at the supply and demand of oil in general, it's very tight, right? You don't have a production of say 300 and a demand of 200, right? Or 100. It's almost like 100 and 101. So if you cut Russian oil production by say 5 million barrels a day, or 5% or whatever it might come out to, you have a potential to increase demand by a crazy amount, or not increase demand, increase price, excuse me, and that's really going to hurt a lot of countries that sanctions we were trying to help, right? So, a lot of these impacts of the sanctions have second and third order consequences that weren't necessarily thought through. And so just pay attention here. This is something that we're all still trying to kind of wrap our heads around, but it is important to say that just because crude oil has dropped recently doesn't mean it's going to continue. I'm going to flip over to just futures contracts here and what the market's kind of pricing in. And you've started to see that go down, but again, just be kind of mindful of where this might end up. You're seeing April 2023 at 87, spot 17, so significantly lower than we are currently. So might be a good time to buy some kind of call options there. But that's kind of my main idea there, is that I don't think we're out of the thick of it yet. I think as, again, winter increases, EU, especially places like Germany, that are super dependent on Russian oil, have multiple pipelines running through it, and have now said, all right, we're not going to take that. If you remember, I think it was a couple months ago, or a couple years ago, excuse me, they stopped production of nuclear. So now you're going into a winter, and German winters are not warm by any stretch of the imagination. There's going to have to be some kind of natural resource that heats people's homes, or they're gonna go cold. So think through what that means. And just recently, kind of getting off topic here, but Germany actually, I think it was Germany, said that they now consider gas ESG, right? So environmentally safe, which is kind of a funny flipping name. But again, this is happening, and they're smart in considering that, hey, we have a long winter ahead. I don't think this Russia-Ukraine situation is going to end anytime soon. There's no treaty on the table as of right now, and it is important to just understand what this could look like over the next couple months. And in my mind, Russia doesn't pull out anytime soon, and they're just going to keep charging along. So let's quickly hop over to the upcoming economic reports, and then we'll go into weekly picks. I know we're kind of getting a little long in the tooth here, so I apologize. But next week, start off the week on Monday, obviously, July 11th, we're going to see a pretty important week coming out of here. A lot of our CPI data, some of jobless reports, retail sales. That's going to be a big one to look at. Retail's not necessarily a canary in the coal mine, but definitely something to pay attention to. The manufacturing index, again, is something that we spoke of last month, consumer sentiment. We had that huge print last month that really shook the market. So a lot of those reports are coming due again. So keep that all in mind. So jumping into our first free pick of the week, we have MPC, Marathon Petroleum Corporation, and we're starting to see a little bit of a turnaround here. I think, again, just because what I've reiterated previously, that I don't think we're going to see a continuation of dropping oil prices here. I think we're going to start seeing a turnaround. So in my mind, it's one of those rare opportunities in a bear market that I'm pretty comfortable with buying the dip here. I think, especially from MPC, that it's a pretty smart pick here, as we're seeing a little bit of a bounce. I do want to wait for us to get a little bit higher before anything substantial gets entered in here. But I think I could probably play this towards the end of the week, depending on what sort of inflation data that we start seeing in consumer sentiment. Now, oil is a kind of a tricky one, because as global demand drops and as a recession eventually starts to come more into fruition, the idea is that, okay, people are going to be driving less, people aren't going to go on as many vacations, oil demand is going to drop. So you kind of have all these different factors at play here, which is why it's so difficult to really get a sense of where these things are headed. But in my mind, this is a pretty interesting play to look at. Second pick here is OXY. Now, this is actually something that Warren Buffett has in his portfolio, a very small position in, but he is a large holder from OXY's standpoint. I think they own about 15%, and that's always kind of nice to get a Warren Buffett sign off, if you will. But regardless, we're seeing a little bit of a kind of bouncing along this 210 moving average, so that's always a good sign as we start to kind of channel up to the right. I think this one's going to take a little bit longer than our previous pick. But I do expect, again, some positive appreciation as oil starts to turn around, especially as we continue the Ukraine and Russia crisis. I just don't see an end in sight, and just a lot of market headwinds right now that hopefully should prop up the price of oil and make for a good swing trade. So that's kind of what I'm looking at here. And to end the video here, I wanted to look at JKS. This was a recent premium pick, so if you're on a premium list, you have access to this, and hopefully took advantage for about a 20% return. This was just tracking up into a nice little channel formation. This is on the 4-hour, but if we look at the daily, you kind of see this up, down, right? So we just played this in our bands and made a nice little swing trade off it. But when you're doing these channel trades, I do like to keep this trailing stop loss versus just leaving it at a certain marker. I always try to play within our band. So definitely reach out if you guys have any questions, but that is JKS, and hopefully everybody profited off that one. Finally, this is the end of the video. I know we got a little bit long in the tooth there. It was a long video for me to get through. I was a little bit tired, but thank you for sticking with me if you did. And I do appreciate any sort of likes, subscribes. We do put all of these out into our blog, and you can see, all previous articles, previous posts. So if you miss one, don't forget to check us out here. It really does help. We have weekly reviews, market performance, recent winners, and then you'll always have this week's pick. So we put 2 free out every week, and our premium members usually get about 10 to 15. So thanks so much, guys, and see you next time.